With Invesco on fixed income and particularly loans, Noelle Corum joins us. And what's wonderful about Noelle is she started out in the trenches of the trading desk as well. And that's really cool. It's very rare that you get academics with her, ability in the classroom that come out of the trenches of trading. What does the loan market look like right now? Invesco's up to their eyeballs in loans. What's the character of the loan market?
Tom, before we get started, I have to tell you that my toddler so perfectly gave me this morning, and I just thought it was too perfect not to show you for St. Patty's Day. So.
Yeah, but it's a St. Patty's Day, which means we have to have a Guinness on tap. Could you get the Guinness?
And for people who are listening on radio, 15th. She held up a big sparkly bow tie from her toddler
green
with sequins, just like
Tom's got one of those at home. He just chooses not to wear it in the office.
Yes.
Carry on, Noelle.
Yes. So,
Noelle, how about those loans?
So let me give you our backdrop of kind of growth. We're just below Goldman, I would say. We're expecting around 7% growth for the year. Inflation, we expect to be messy, and that's ultimately going to keep the Fed on the sidelines. We do expect, as inflation is messy, we could see some more rates volatility, and we could see, as a result, loans demand, and you've already seen that. You've seen the retail investors step in in a significant way. I would, caveat that the retail investor also steps out, when they start to get worried pretty quickly. So just, of course, we never suggest putting all your eggs in one basket. Diversify where you can, especially with levels where they are, in terms of valuations. Diversify across bond asset classes.
Noelle, this is really important. Typically, when we talk about fixed income, we don't talk about retail participation. What is that incremental retail participation in leveraged loans like? What does that look like in the last month or so?
It's really stepped up because, right, a lot of investors are worried about that rates volatility. We haven't seen it, though. We haven't seen the volatility carry through into the other asset classes, though. And that's kind of, the main reason that we're still bullish on credit. I wouldn't say we're over our skis in risks here, but we do think that growth is going to be supported for fundamentals this year. And that is ultimately why, we would suggest investing in bonds. We think the growth is going to support companies throughout the year, and that's really what's going to be the story in 2021.
Noelle, I want to pick up on one of your lines, and it's without context. You can give us that in just a moment, but it's something I've read a million times in fixed income, and I've read it over the last month. I've read it 6 months ago, 9 months ago, and over the last several years too. Valuations are rich, thus investors are not getting paid for this risk. Is that just the story in fixed income? Is that the new normal, that valuations will always be rich and investors will not be getting compensated for risk because we live in a new world now?
So it is a new world. We are, at very rich levels. And we do think a lot of this year will be about clipping the coupon. But because of the volatility that we are likely to see in stocks, the rates, it does make sense to diversify your portfolio. So, of course, we're actually seeing a lot of crossover investors and a lot of crossover demand come into high yield EM to pick up the yield there and diversify their portfolios there, and then compensate themselves. We still think there's some value specifically within the services sectors that you can also pick up. And there's still a little bit of value in leveraged loans relative to high yield and, of course, IG.
Taking a step back, there's a larger question going forward about whether the Fed has put a floor under the default rate. In other words, is the Fed put basically going to prevent the default rate among corporate debt from getting too high, because they will sweep in and they will end up buying that debt and reducing borrowing costs enough to let these companies continue to survive?
This year, it's really about growth, right? And, we expect defaults to come down. In IG, we expect lower supply. It's going to be a lot about deleveraging. So a lot of companies are making the right moves that we would expect in a high growth year. We would, expect most of the growth to come in the next couple quarters as the stimulus is spent, of course. And then, in Q4, we would start to look for any kind of creeping back of COVID concerns. But ultimately, we expect to end the year at potential in terms of growth.
So if credit risk isn't the main risk here, are you delving also into the riskiest of corporate debt, the CCC rated stuff, even on the fixed side, even on the bond side?
A little bit. I'd say because valuations are where they are, and if you see continued volatility, and you're not being compensated as much as you'd like it as an investor with rich valuations, it doesn't make sense, of course, to go over your skis on risk and take a bunch of risk in your portfolio. But it does make sense to reach incrementally into these higher risk areas, because we do expect growth to support these companies and allow them to improve their fundamentals on the year.
Noelle, good to see you, as always, and love the bow tie. Noelle Corum there.
Good luck.
Can I just say,
Portfolio
John,
manager, wasn't that great? Go on, Lisa.
You started out the program talking about a Sesame Street reference.
I did, yeah.
We ended up, first of all, do they watch Sesame Street in the UK? Did you grow up watching it?
We watch Sesame Street
Really?
in the UK. Yeah, sure.
Okay, and we got that, and then
So
we
did
got the bow tie.
Tottenham this weekend, obviously.